There's a price problem sitting at the center of the global silver market right now, and not a single anchor on mainstream financial television has said a word about it today. Here's how it works. Take 1 ounce of silver, carry it to a registered vault in Shanghai, walk out with $12. Now take that exact same ounce of silver, walk it into a vault in New York, walk out with $80, same metal, same element, same atomic weight. 2 markets, 1 planet, $14 apart on the same Tuesday morning. If that number did not just stop you cold, I need you to stay with me for the next few minutes. Because the number that matters in this story is not $80. It is not $12 either. The number that matters is the $14 sitting between them. And what that $14 is communicating about the true condition of the global silver market is something no financial news desk is going to walk you through today. Today is February 25th, 2026. Yesterday, the Shanghai Futures Exchange came back online after 9 full consecutive days of silence for the Lunar New Year holiday. 9 days dark, the longest single blackout period that the world's largest physical commodity exchange goes through all year. And what happened the moment trading resumed? Silver did not drift higher. Silver did not inch up modestly. Silver surged immediately to 22,634 yuan per kilogram. Convert that at today's exchange rate, and that number becomes approximately $12 per troy ounce in Shanghai. Meanwhile, New York was sitting at $80. That is a 16% premium being applied to a commodity that is supposed to trade at a single unified price everywhere on Earth. By the time you finish reading this, you're going to understand precisely why that premium exists, why it is not shrinking, why the Shanghai Futures Exchange has suspended approximately 23 accounts throughout February alone for attempting to push silver prices downward, and why what happens in the next 72 hours could determine whether the paper silver market continues to function the way it was designed to function. This channel has been tracking the Shanghai Silver Premium as a live data series for months. Not as a theory, not as a forecast, as a number we record every time it moves. 6 months ago, the average Shanghai Silver Premium was running at 6.59%, elevated but containable, the kind of figure that earns a footnote in a commodities research report and nothing more. Then came January. During the crash that pulled silver down from $121 per ounce all the way to $64 in under 30 hours, the Shanghai Premium spiked to 34%, a number so enormous that every arbitrage desk on the planet was watching it in real time, and still nobody could close it. Then the Lunar New Year holiday arrived. The Shanghai Exchange went dark for 9 days. Here's what makes yesterday's reopening fundamentally different from any ordinary market resumption. Physical silver buyback prices in Shenzhen, which is the secondary market where industrial buyers and dealers transact on real metal rather than paper contracts, were already running near $95 per ounce on February 23rd, the day before the exchange reopened. The physical market did not sit around waiting for the exchange to tell it what silver was worth. The buyers who needed actual metal priced it themselves at a premium that confirmed the supply picture had not improved $1 during the 9-day holiday closure. When the SHFE opened yesterday and silver ran immediately to $12 in Shanghai pricing terms, that was not a surprise print. That was the exchange catching up to a physical reality that back channels had been pricing in for 9 consecutive days. Now hold this detail in your mind because it becomes critical later. The Shanghai gold premium right now is 0.29%, 29 basis points. Silver's premium is 16%. Silver's premium is roughly 38 times larger than gold's premium at this exact moment. Same exchange, same city, same Tuesday. If this were a broad, generalized commodity panic, a mass flight from paper into physical metals, gold and silver would both be carrying meaningful premiums. Gold is at 0.29%. That number tells you this divergence is not a commodity market story. It is a silver-specific physical supply crisis. And the data is telling you so with arithmetic precision. Let me make the mechanics concrete because the word arbitrage gets used loosely and this situation deserves clarity. In a functioning global commodity market, a price gap this large cannot survive for more than a few hours. The mechanism that eliminates it is straightforward. A trader identifies the cheaper market, buys the metal there, physically moves it to the market where it commands a higher price, delivers it, collects the spread. In doing so, that trader pushes the low price upward and pulls the high price downward until the gap disappears entirely. For gold, the spread between major global exchanges typically lives below 50 cents per ounce. For copper, $1 or $2 between London and Chicago on a heavy volume day. For silver, as of this morning, $14. And that gap widened during the opening session rather than narrowing. So why is the arbitrage mechanism not working? Because closing a $14 spread does not require a clever trade idea. It requires physical silver, real metal, real bars sitting in a real vault that can be loaded onto a real aircraft and delivered into a Chinese bonded warehouse. That metal is not available, and the reasons it is not available are not logistical. They are structural. They are regulatory. And within the current architecture of the global silver market, they are permanent. Two markets, one metal, $14 between them. The gap is widening, not narrowing. And the exchange operating in the higher priced market has suspended approximately 23 accounts throughout February alone for attempting to build downward pressure on silver prices. That is where we are. Let me give you the verified data points because this analysis does not operate on impressions or speculation. Silver spot price in Western markets today is approximately $88 per troy ounce, down roughly 1% from Monday's closing price of $88.90. Today's session range ran from $84.65 to $88, a contained, almost quiet range. Nothing that would interrupt a CNBC segment on retail earnings, nothing that would push a breaking news alert to your phone. Shanghai Futures Exchange today, 22,634 yuan per kilogram, converting to approximately $12 per troy ounce. The spread, $14. The premium, 16%. Before the Lunar New Year break, the Shanghai premium was already running at 11%. Physical buyback prices the day before reopening were near $95. Today's session did not create this premium. Today's session accelerated an existing structural dislocation that has been building for months. Gold today was approximately $5,168 to $5,180 per ounce, down 1 to 1.5% from Monday's close of approximately $5,260. On Monday, gold touched $5,150, the highest level since its all-time high of $5,194 or 82s set on January 29th. Gold-silver ratio today stands at 58.74 to 1. In April 2025, that ratio stood at 100 to 1. That is 41 points of compression in 10 months. When this ratio contracts at this pace, it has historically marked the precise phase of a precious metals cycle, where silver begins to decisively and aggressively outperform gold. COMEX registered silver, which is the metal specifically earmarked and physically available for futures delivery, stands at 88.2 million ounces as of February 22nd. 4 months ago, in October 2025, that number was 167.7 million ounces. 47% of deliverable COMEX inventory has been physically removed from registered vaults in 4 months. The rate of removal is not slowing. In the single week of February 12th through 18th alone, 1407 million ounces left registered vaults. That is a 13.8% decline in registered inventory in 7 days. Net physical outflows over the trailing 30 days total negative 54.89 million ounces. 3.66 million ounces came into the system. 58.54 million ounces walked out. On February 18th alone, HSBC's registered holdings dropped by 641,000 ounces. Brinks lost 596,000 ounces on that same day. These are not clerical adjustments. These are not bookkeeping entries. These are deliberate, documented physical removals of real metal from the deliverable supply chain. Now let us go directly to the source code of this dislocation. Why is Shanghai pricing silver 16% above New York? Why can the arbitrage mechanism not close it? There are 3 structural forces driving this separation. All 3 of them are permanent within the current regulatory framework. None of them are resolving in the next earnings cycle. Force 1 is strategic reclassification. China officially designated silver as a strategic material on January 1st, 2026. That designation came with binding export licensing requirements attached to it. Only 44 companies received approval for the 2026 to 2027 export cycle. Each applicant was required to demonstrate a minimum annual refining capacity of 80 tons. Below that threshold, no license, no export, no exceptions. Here is the full weight of that policy decision. China controls approximately 65% of the world's silver refining capacity. When the entity responsible for processing nearly 2/3 of global silver supply restricts what can physically leave its territory, there's no alternate route available. There's no parallel refining infrastructure sitting in another jurisdiction capable of absorbing that volume. The bottleneck is not a port. It is not a freight rate. It is not a shipping container shortage. The bottleneck is the refinery itself, and the refinery is inside China. Force 2 is domestic industrial priority. China is simultaneously the world's largest manufacturer of solar panels, electric vehicles, and consumer electronics. All 3 of those product categories rank among the highest consumers of silver per unit of output. Solar panels use silver paste in their photovoltaic cells. Electric vehicles use silver in their battery management systems and electrical contacts. Consumer electronics use silver across circuit boards and connectors at scale. When the Chinese government restricts silver exports, it is enforcing a domestic priority rule that has an industrial logic behind it. Chinese manufacturers get the metal first, foreign buyers receive whatever remains. Right now, what remains is essentially nothing. Force 3 is regulatory and capital friction. There's a 13% value added tax applied to silver transactions inside China. There are import quotas administered directly by the People's Bank of China. There are capital controls that make converting yuan proceeds back into US dollars slow, expensive, and bureaucratically intensive. The combined friction of these three mechanisms means that after January's silver price crash, the effective post-VAT premium inside China reached 45.8%. That is a $34 per ounce arbitrage gap that the entire global financial system watched in real time and could not close. Not because closing it was difficult, not because closing it was expensive, but because closing it was structurally impossible under the current market architecture. And that architecture is not softening. Every enforcement action taken by the SHFE throughout this month confirms it is hardening. Here's the regulatory development that broke this morning and that the financial press is not covering. The Shanghai Futures Exchange issued notice number 46 today, February 24th, 2026. In that notice, the SHFE announced the suspension of another group of trading accounts for violating Article 16 of its abnormal trading behavior management rules. The specific breach was exceeding intraday position opening limits on silver contracts. The exchange imposed restricted position opening measures on the identified accounts effective immediately. This is not an isolated action. On February 5th, notice number 37 suspended 6 separate groups of linked accounts for the identical violation. In late January, additional groups totaling 34 clients received restrictions. Over the course of January alone, the SHFE processed 125 flagged abnormal trading behaviors. That total included 38 intraday opening volume violations. One client was placed under direct control restrictions. 39 control relationship account groups were also restricted. The total count of accounts suspended or restricted in February alone has now reached approximately 23. The SHFE did not leave the threshold where it was either. On January 27th, the exchange lowered the intraday position opening limit to 800 lots per day. That tighter ceiling makes it significantly easier for large traders to trigger violations simply by operating at normal institutional scale. That is intentional. The exchange is deliberately calibrating the threshold to surface the exact behavior it intends to catch and punish. Now, who are these accounts? The SHFE does not publish account identities in its public notices. The data does not confirm the identity of the suspended parties. What is in the public record is this. Disruption Banking reported on February 4th that JP Morgan allegedly closed a massive short position at the exact intraday bottom of the largest single-day silver price decline in 44 years. COMEX delivery data shows JP Morgan involved in February silver deliveries of 633 contracts at an average execution price of $7,229. Whether the suspended Shanghai accounts have any operational connection to Western financial institutions remains entirely unverified. The pattern concentrated in silver, time to record premiums, targeting accounts building downside pressure is documented in public. The Chinese regulatory apparatus is sending a clear message to whoever is attempting to engineer silver prices on its domestic exchange. That message was issued this morning. On the same day, Shanghai crossed $12. Now let us go beneath the inventory headline number and into the deeper structural plumbing of the system, because the story is considerably more layered than a single headline figure suggests. Open interest on the March 2026 COMEX silver contract stands at approximately 43,971 contracts. Each contract represents 5,000 ounces of silver. Total contractual demand implied by that open interest is 219.9 million ounces. Registered inventory available for physical delivery is 88.2 million ounces. So the arithmetic looks like this. 219 million ounces of paper claims. 88 million ounces of deliverable metal physically sitting in vaults. Heavy Metal Stats classifies the current coverage ratio at 3.8 times, meaning there are approximately 8 claimants for every single registered ounce currently inside the system. First notice day for March delivery is February 27th. That is 72 hours from now. On that date, any long contract holder who has not rolled their position forward or closed it outright may formally request physical delivery of the metal underlying their contract. If even 15 to 20% of outstanding March contracts stand for physical delivery, a fraction of the total open interest, the registered inventory cannot mathematically satisfy the demand. The system would then be required to source metal through conversion from eligible holdings, import from outside the exchange network, or resort to cash settlement at premium prices. None of those outcomes are clean. None of them are painless. February deliveries, which is historically a minor month on the silver calendar, have already broken records that stood for years. 4,695 contracts totaling 23.475 million ounces have been delivered month to date through February 20th. 2,155 contracts were delivered in just the first 2 trading days of the delivery period alone. January 2026 deliveries reached 49.4 million ounces. That is more than 7 times the January 2024 level. Full year 2025, COMEX silver deliveries reached 474.4 million ounces, more than double 2024's total of 202.7 million ounces. The physical demand coming through the futures delivery mechanism is not a seasonal anomaly. It is a structural acceleration that is compressing the available inventory at a rate the system was never architected to sustain. And there is a behavioral anomaly developing among contract holders right now that deserves your full attention. Traders are backward rolling. Instead of extending their positions forward in time, which is the normal behavior for someone managing paper silver exposure and wanting to maintain a long position without taking delivery, they are rolling from March contracts into January and February contracts for immediate or near immediate delivery. That directional reversal tells you something precise about intent. These are not participants managing a financial position on a spreadsheet. These are participants who want physical metal and want it delivered soon. Now, the options market is confirming the same signal from a different angle. SLV, implied volatility, as of February 19th, was running between 99 and 1.3% annualized. The 12-month historical realized volatility of SLV has averaged approximately 45%. Options traders are pricing in more than double the historically realized volatility going forward. That is not a routine elevated reading. That is the options market communicating a genuine structural uncertainty about where silver prices go from here and how fast they get there. When implied volatility runs at more than twice realized volatility on a major commodity ETF, the market is not speculating about direction. It is pricing in the genuine possibility of a discontinuous price move, a gap, a regime shift. Not a gradual drift higher, but a sudden repricing event that the current settlement infrastructure may not be designed to absorb smoothly. Step back from the individual data points for a moment and look at what the complete picture is assembling. COMEX registered inventory down 47% in 4 months. Net outflows of 54.89 million ounces over the trailing 30 days. February deliveries breaking multi-year records. Traders backward rolling into near-term delivery contracts. Shanghai premium at 16% and widening during this morning's session rather than narrowing. Gold premium at 0.29%. Gold-silver ratio compressing from 100 to 1 down to 58.74 to 1 in 10 months. The SHFE suspending 23 accounts in February alone for attempting to suppress prices. China designating silver as strategic material with binding export licensing on January 1st. Only 44 companies cleared to export for the full 2026 to 2027 cycle. 65% of global silver refining capacity locked behind that licensing wall. A 13% VAT. People's Bank of China import quotas. Capital controls slowing dollar conversion. A post-VAT effective premium that reached 45.8% in January. A $34 arbitrage gap that the entire global financial system watched and could not close. Every single one of those data points is pointing in the same direction, and they are not pointing there independently. They are reinforcing each other in a sequence that has a logical endpoint. The physical silver market and the paper silver market are operating under increasingly different assumptions about what silver is actually worth. At some point, one of those assumptions has to break. The question that every serious market participant should be sitting with right now is not whether this dislocation exists. The data has already answered that question with arithmetic precision. The question is, what happens when the paper market and the physical market can no longer maintain the fiction that they are pricing the same asset? Because that moment is not a theoretical future event. The signals embedded in the data we have walked through today suggest it is already beginning to happen in slow motion. In the next 72 hours, around February 27th, First Notice Day could accelerate that process in ways that settlement desks across New York and London are not publicly discussing. Let us talk about what a genuine delivery squeeze looks like in mechanical terms, because the word squeeze gets used loosely and this situation deserves precision. COMEX open interest on March. Silver stands at 43,171 contracts, representing 219.9 million ounces of contractual demand. Registered deliverable inventory stands at 88.2 million ounces. That is the official number. But registered inventory is not a static pool. It has been declining at 13.8% per week. If the outflow rate that ran through the week of February 12th to 18th continues at even half that pace through the end of February, the registered inventory number on First Notice Day will be materially lower than the 88.2 million ounces sitting on the books today. The pool that contract holders are expecting to draw from is actively shrinking, while the queue of participants wanting to draw from it is actively growing and moving toward the front of the line. When a delivery squeeze develops on a commodity exchange, the exchange has 4 mechanisms available to it. First, it can allow cash settlement at a negotiated premium. Second, it can facilitate conversion of eligible inventory into registered inventory, which requires vault operators to certify metal that was previously held outside the delivery chain. Third, it can source metal from outside the exchange network through emergency import arrangements. Fourth, it can implement position limits and force liquidation of long contracts at market prices. Every one of those four mechanisms carries a cost. Every one of them sends a signal to the broader market about the true state of physical availability. None of them are invisible. And in the current environment where the Shanghai premium is 16%, where China's export licensing wall is fully operational, where 65% of global refining capacity sits behind that wall, options 2 and 3 become significantly more difficult to execute cleanly than they would be in a normal market environment. The Federal Reserve's posture through all of this is worth examining carefully. The Fed has held rates in the current range, while inflation in physical commodity markets tells a story that the headline CPI number is not fully capturing. Silver at $88 per troy ounce. Gold at 5,768 ounce to 5,180 per ounce, a gold-silver ratio that has compressed 41 points in 10 months. These are not the price signals of a commodity market in equilibrium. These are the price signals of a market where institutional money is making a very specific allocation decision. The decision is this: in an environment where paper claims on physical assets are multiplying faster than the physical assets themselves, owning the physical asset or instruments directly tied to physical delivery is worth a measurable premium over owning a paper derivative of that asset. That premium is currently 16% in Shanghai. That premium was 45.8% in January when the system was under maximum stress. And the structural conditions that generated that January premium have not been resolved. They have been reinforced by every regulatory action the SHFE has taken throughout February. Now consider the gold-silver ratio compression in the context of what it historically signals. When this ratio moves from 100 to 1 down toward 50 to 1, it has historically marked the phase of a precious metals cycle where institutional capital rotates from gold into silver in search of the higher beta return. Silver becomes the high-velocity expression of the same macro thesis that gold has already begun pricing. Gold touched $5,250 on Monday. Its all-time high was $594.82 on January 29th. The distance between Monday's high and the all-time high is approximately $344. In percentage terms, gold is approximately 6% below its all-time high, while silver at $88 remains significantly below the price levels that the physical market in Shanghai and the Shenzhen secondary market are already pricing through buyback rates near $95. The Western paper price and the Eastern physical price are not converging, they are diverging. And they are diverging on a day when the exchange regulating the Eastern physical market issued its latest enforcement notice and simultaneously watched its silver contract open above $12. The arithmetic of the coverage ratio deserves one final examination before we close. 219.9 million ounces of open interest contractual demand, 88.2 million ounces of registered deliverable inventory, a coverage ratio of 3.8 times. In January 2026, 49.4 million ounces were actually delivered. That single month's deliveries represent 56% of the current total registered inventory. Full year 2025 deliveries of 474.4 million ounces represent more than 5 times the current registered inventory. The system is turning over its entire deliverable stock multiple times per year, while that stock is simultaneously declining at 13.8% per week. These numbers do not describe a market operating with comfortable buffers. They describe a market operating with structural tension that is being managed one delivery cycle at a time. What happens next is not something any single analyst can predict with certainty. Markets are not equations. They are systems of human decisions made under uncertainty with incomplete information. But what the data does allow with confidence is this assessment. The conditions required for the Shanghai premium to narrow organically are not present. The conditions required for COMEX registered inventory to rebuild at a pace that restores comfortable coverage ratios are not present. The conditions required for the gold-silver ratio compression to reverse without silver, first making a significant move toward gold's pricing level, are not present. And the conditions required for the paper silver market and the physical silver market to continue pretending they are pricing the same asset at the same value are becoming more difficult to sustain with every passing delivery cycle. 2 markets, 1 metal. $14 between them today. That number is the most important number in the global commodity market right now, and almost nobody on mainstream financial television is saying a word about it.